भाव भगवान छे. While talking to various clients uh, or various potential clients, we keep getting asked that, yeah, look, direct is probably going to save you money, and an advisor is probably going to cost me more, anywhere from 0.5% to 1%, or even an MFD that is going to cost you more from 0.5% to 1%. And my advice to them is that, look, always have all the information. And through this video, the idea is to give you that information and take you to the edge of decision making where you are much more better equipped to decide whether doing it yourself or through an advisor or through an MFD. Now, investments are simply not just going to a website and buying the best performing fund. In fact, according to a CFA report, and you can see this graph, that's probably one of the ways to consistently underperform. And not to say that at the end of a 5-10 year period, you'll be left with multiple funds which have done well in the past, but they keep changing, right? Uh, you also have to be able to gauge the risk in different products, evaluate your risk taking capacity, and assuming you are able to justify and actually understand how much risk you are able to take. So many of us still don't have nominations in our investments and banks, right? Forget nomination, a minuscule amount is even covered with adequate insurance for our dependents. Without help, you really need to ask yourself if your dependents are equipped to handle and transfer and even claim your investments or the policy once an event has occurred. Do they even know what your investments are? Look, this is not to scare you, right? And that's never the idea. But please ensure that if you don't have an advisor or someone who knows where all your wealth is, at least maintain a spreadsheet clearly labeling where your investments are. Is it in a bank? Is it with an advisor? Is it with an MFD? Is it with one of these online platforms, etc.? Harping on lower costs appeals to all our inner voices as Indians, and our brain automatically translates it to savings. But there is almost always a higher price to pay in the future. And I see so many professionals investing in FDs and not even beating inflation in the longer run just to avoid paying fees on maybe a mutual fund or any other investment. The cheaper plan will always look good in the shorter run. In fact, we are seeing a lot of attention being given to indexing and the benefits, etc., etc., etc. Our research on indexing and index funds tells us that instead of the marketing spiel that you generally get with index returns, which says, we'll beat most active funds, we are low cost, you're in fact getting lower returns to the tune of 0.5% to 0.7% compared to actual index returns. We have a couple of links in the description if this is something that you want to look at as well on index funds. Of course, selecting funds is no easy feat, right? We have mutual funds, PMSs, AIFs, structured products, REITs, Invest, fixed income, and a whole bunch of random products like bill discounting, P2P lending, yada, yada, yada. And the list can literally go on. The process of selection is also multifold. Selecting your allocation, determining the style of the funds, making sure you monitor them through its ups and downs, taxation, optimization, recalibration, etc. All things that you have to look at. The options within each structure are also increasing, and so is the dispersion of results. In the last few years, within even the regulated funds by SEBI, the dispersion between the minimum and averages can exceed 15%. And that's at CAGR level, right? Over 3-4 years. Imagine the different returns that you could have from maybe your friends and colleagues and the emotional roller coaster that you will go through. Even picking the right fund is half the job done. We always hear stories about how if we had held on to the stock for 20 years, 10,000 would have become 10 crores. Unfortunately, the reality is that over even 2 years, 75% of all mutual fund investors churn their portfolio. And you can even go and check your own portfolio. What is the churn rate on your own portfolio? Is it a buy and hold that you've never turned? Is it something where you're chasing a shiny new coin? On top of this, our behavior also determines alpha to a good degree. Uh, Timing, while sexy, will hardly add returns in the long term. And let's do this exercise, right? Pick one of the options shown, and we'll discuss this towards the end of the video. And I'll try and explain why time in the market is probably more important than timing the market. A lot of us have day jobs, and giving time and dedicating a portion of your daily routine as well to earn a second income can be taxing as well as a bit boring if the markets sort of go to sleep in the interim. And yes, you might be using or wanting to use, these new age loss making, cash burning, MF execution only platforms whose sole proposition is to save you that 0.5% or 1% on expense ratio, and they claim that this can lead to a big difference in the future, and so and so and so, etc. But what they don't tell you is which funds are suitable for you. How to navigate newer ideas, keep you in sort of track with your investments, and not keep churning your portfolio based on a new shiny coin that comes into the market, or a stock that's gone from 20 to 70 and it's a must have stock. And the most important thing is to be with you throughout the roller coaster of the life cycle of your investments. So here's the deal for you. If the focus is on the input of saving the 1% and you're confident in your ability, then definitely go for these direct plans. Right? There's nothing better than to do it yourself. If, however, you need a sounding board from time to time across market cycles and ensure that you're invested for the long term, most definitely start exploring what an advisor is telling us. For almost all of us, a good night's sleep trumps everything, doesn't it? Now, coming back to timing, as you can see, across all the scenarios, the expectation of returns in almost all the scenarios you land up with is making at best a marginal amount. And if you were to consider that you would do this over maybe once in 2 years or once in 3 years, this expectation reduces by that amount as well. If you have any other practical scenarios where you've made money consistently across the past decade, do put in your comments. It has to be very clear as to what is possible and what is not possible. I hope this video has been useful, at least slightly getting you closer to the edge of decision making, right? And if you think it's going to help someone else in making that decision, please feel free to share. You can get in touch with us if you personally need help. I'm more than happy to guide you through what we can offer as well. Okay, see you guys later. Bhau Bhagwan Jai.